Good evening. This side, Rahul Magan here. Guys, when you form a startup, now whether this startup is a grocery based startup, it's a software based startup, it's a space engineering startup, it's a 3D product startup, or it could be a technological startup, or it could be like what I started in 2016, which is finance startup. You need to learn that you supposed to have something in your kitty which is called options pool. That's very important. Yes, in my case it was not relevant because I never intend to make my company public. I never intend to raise the money from the public and then, invest this money in terms of factories, in terms of offices, in terms of software development and all this. No. I always wanted to keep my company private, no public, as simple as that. But having said that, the startups who have big ambitions, unfortunately, what is happening with these big ambitions, it's known to us, but we are not covering in this video. They supposed to have something which is highly technical, subject to accounting, interpretation issue, which is known as options pool. Guys, options pool is nothing but a form of authorized capital. I repeat, if you form a startup, you supposed to have an authorized capital. Let's assume that your authorized capital is 100 US dollars, assuming, and you divide this into share of $1 each. I repeat, you launched startup, be it any domain, and your authorized capital is $100, $1 per share, which means the 100 share is the total allocation which you are giving. It's a big mistake that the both founders going to be 50-50, provided you knew that your company needs a lot of capital like Byju's, Swiggy, Zomato, Lenskart, Paytm, Zomato, Uber, Ola, and the list is very long. In this eventuality, slowly and steadily, you have to bring the private equity, you have to bring the venture capitalist, and in some cases you have to bring the venture debt also into the picture. Now in 2022, when the startup funding is declining worldwide, the private equity and the venture capitalists are sitting on a huge dry powder. In the parlance of private equity and venture capitalists, dry powder means that they took the funds from public, or maybe some family offices, maybe some hedge funds, maybe some ultra high net worth individuals, or you know the list, and then they are committing some returns to them, whatever they would be committing, and then they would be investing this money in these startups. Now, when they've not been able to invest, or they not been able to get a target, in this eventuality, they end up keeping that cash, or maybe the fund, or maybe the credit line, or maybe the line of credit in their books. And this is having a huge cost. And this is known as nothing but the dry powder. Guys, please understand that options pool, suppose you have 100 shares of $1 each, total $100. I already told you that keep at least 20% as option pool, which means 100 minus 20 equals to 80. Now this 80 can be equally divided between both partner 1 and partner 2. 40 and 20 is the option pool. That option pool should not, I repeat, should not have any claim from the founder or the promoters. It's a big mistake if partner 1, partner 2 still have a stake in this option pool of 20. I have seen many agreements in my life on a consulting note, and what stupidity I have found, that of course these startups created option pool. That's a good thing they did, but partner A, partner B, 40, and the rest 20% is both having their stake in that 20%. This is absolutely incorrect. I have seen that. I don't want to quote any Indian startup because it's a big company and in huge losses. They also have a similar kind of structure, and their option pool is huge. I can't give you the figure. Guys, do also remember that options pool is subject to valuation issues, which means at the end of the month, at the end of the quarter, and at the end of the year, you are supposed to do the accounting of the same. So if you are keeping 20 as an option pool, example 40 to one partner, 40 to another partner, 20 as an option pool, in this eventuality, you are supposed to do the accounting. And please remember that this option pool is not EPS neutral, which means probably one time it would come as 100% profitable, go to the credit side of the P&L. It will push your EPS unnecessarily, inorganic way. One time it will go to the debit side of the P&L. It will push down your EPS inorganic way. And investors, novice investors, people who have zero understanding of the accounting, they always in trouble. They feel like, guys, what the hell? One quarter you are plus, one quarter you are down. They don't understand the credit goes to options pool. So when you are forming a startup, remember very carefully, keep the options pool. There are variety of structures we have in option pool. We have almost 5 or 6 different structures in the option pool. So it should not be generalized that 40 here, 40 here, 20 here, thank you, my job is done. No, it's not like that. A proper and appropriate structure, I repeat, proper structure of options pool should be taken into consideration. This is what I would like to say. This is Rahul Magan here from Pressure Consulting Group.